the world's largest retailer, Walmart. We've been talking about that, reporting fourth quarter earnings this morning that were mixed. My next guest has a buy rating on Walmart with a price target of $61 a share. Daniel Binder is a managing director at Jefferies Co. He joins us now from his firm's camera in Midtown Manhattan. Dan, great to have you join us. Thanks so much.
Thanks for having me.
Okay, so Walmart, the results coming in, as you know, a beating on the bottom line, but really everyone focused on these comp store sales figures. What did they tell you about this year for Walmart?
Well, comp store sales were slightly below plan. They were down 1.2%. Company had a plan of -1 to +1, and the company had a slightly disappointing traffic, and that was a function of a lot of remodel activity they've been doing. I also think that that core consumer that they cater to is a lower household income customer. They're more constrained than the average consumer right now, with much higher unemployment rates, and the company's also been challenged by deflation in food, but that has started to ease, so that's good news.
And Dan, the other thing is that the expectations on the profit side looking ahead haven't changed that much. Do you change your stock expectations? I mean, your $61 price target seems to be bang in line with what, on average, the street's looking for over the next 12 months from Walmart.
Yeah, the company guided $3.90 to $4. We thought the range might even be slightly wider, up to $4.05, but we and the street are in the upper half of their guidance. I would just point to the fact that this company has a conservative posture when it comes to guidance, as they did for the fiscal year 10 year that we just ended, and ultimately ended up beating by several pennies each quarter. So I would say guidance was pretty much as we expected. I think we're at an inflection point with this company where the earnings growth profile is going to change. This is a company that was beating on gross margin for the last couple of years, and what I think you're going to see happen in the coming year is a bigger reinvestment in price in key win categories and better expense leverage on lower comps, in the low single digits, which is something they haven't been able to achieve. And I think when you start to get that productivity loop up and you start driving more volume, you're going to see better top line and better earnings growth, and I think you actually have a chance to see earnings growth accelerate off of last year's numbers. So I still like the name.
So in other words, Dan, hey, it's Adam here. What you're saying is it's not just a cost story. You're saying they can actually compete on price as low as they are and still drive the top line higher?
Yeah, I think what you've seen in the last 5 or 6 years is a cost structure at Walmart that has risen. And as a result, they had to let gross margins rise along with that to get the returns that shareholders wanted. And I think that while they were the low price in the market, some competitors did close the gap a little bit. I think they are going to open that gap up again in 2010 and drive additional volume.